Colombo Private Limited. And this is yet another of those webinars that have been organized under the aegis of the ICCSL, dealing with matters that are of very serious concern, and that has to do with the economic outlook, of which we now have had an update presented on screen just a moment ago. So we are able to recognize that there is much interest in what the future holds post-COVID, quite obviously. And there is a certain hopeful sign and a kind of an upbeat feeling with regard to how things will develop in the days ahead. Now, investment is obviously something of the greatest importance at this time. And this season has brought in a great deal of attention toward investment. Where? Well, that's the question, I guess, that will be answered during the course of the presentation and the discussions that will be held with our panel. And Sri Lanka, yes, Sri Lanka has something to lift it and afflict it. Did I say afflict? Well, I did. Now, how these things will finally turn out is a matter that will need to be dealt with. But right now, we are going to be inviting a presentation by the Boston Consulting Group. Now, for those who are viewing this, we would like to mention that there are several platforms that are currently on concurrently, which would enable you to watch the proceedings. They are Facebook Live on the accounts maintained by ICCSL, CIMA, DAILYFT, YouTube Port City, as well as a TV channel on Pure TV, channel number 20, maintained by Event TV. So all of those will be carrying these proceedings live. So you're welcome to observe and listen in. Now, let me move directly to the Managing Director and Partner of BCG, that's the Boston Consulting Group, Mr. Jha, who is poised, ready and waiting to take us through his presentation. So over to you.
Thank you. Can you see the screen? Just to check.
Yes, Siddhi.
Yeah. All right. Thank you very much for giving the opportunity. And I think it's a pleasure to speak to such an esteemed audience and kicking off the webinar on investing in the new normal. I think it's a very, very positive time as we look at the investment markets globally. You know, when the pandemic hit about 15 months ago, analysts had expected that globally we would start seeing a reduction in wealth and the contraction in wealth. But as we look at our own internal studies, we saw that a pandemic couldn't break the global wealth resilience. The global wealth today is at an all-time high. It has grown at 8% over the last year, in the pandemic year. And it is not just it has grown, but it has grown faster than any of the years before. And this growth has not come in parts of the world. As we look at the spread across the world, all regions have demonstrated a growth in wealth held by the individuals. There has been health in the real asset side as well as the financial asset side. But really, all markets have grown. And the focus of this webinar, which is on Asia, is one of the markets which have grown the fastest. Asia demonstrated about an 11% growth compared to an 8% growth in wealth globally. So a pandemic couldn't stop the growth of the wealth. And as we look at whether this has been a typical year, from that perspective, it has been anything but typical. In the last 20 years, where we have looked at global wealth year on year, we have seen many dips. We have seen a dot-com crisis. We have seen a subprime crisis. All of these economic and financial events have actually hit the total global wealth. But this time, it has only gone up. And it has gone up because of two primary reasons. Globally, savings rate in the time of uncertainties have grown significantly. And after the initial fears, all stock markets have actually demonstrated a very strong performance. The resilience of businesses has actually been proven in this time, and that is what is reflecting. Now there is a question that are the markets overheating, but right now many countries have seen multiple waves. There has been no sign of slowing down, and this has really resulted in looking at investment in the new normal. And we do believe that this phenomena that we are seeing will actually change the way people invest, especially in developing regions like Asia. So just for context, Asia invests very differently from global markets. If you look at Asia as an investment market, this page only talks about the financial investments. The financial investments in Asia are still dominant on cash deposits and instruments which have limited returns. Whereas we look at more developed markets like a North America or a Western Europe, the patterns are very different. There is a lot of savings and investments which are in listed shares, equities, investment funds. There is a big gap between what we are seeing in Asia and what we are seeing in a developed market like North America. Even markets like Western Europe, even though equities may not be a big portion, it is still dominated by some non-investable assets, but important for a economy which has aging population, which is in the form of life insurance and pensions. So in Asia, we actually expect a lot of change in the way investments are going to happen. And as yields start maturing and as interest rates come down, we expect a lot of shift to move from cash and deposits into higher yielding assets going forward. And to just give you an example of what is the potential in the region, if you look at markets like mutual funds, which is a simple product that can go out to the masses, which can really help in bringing investments and equity to the common masses. There is a great deal of penetration opportunity that we see in the Asian markets. If you look at some of the global markets, they're running at about 70 to 80% of mutual fund industry size as compared to their GDP. Countries like India, China, Sri Lanka are seeing phenomenal growth in increase in mutual fund market sizes, but it is still very small compared to all the developing markets. Sri Lanka has grown from about 0.2% in 2008 to about 2% now. So it has gone up 10 times in the last 12, 13 years. But there is a large coverage that is possible. And as markets mature, this is the direction they're going to move. And let me take you to the change that we are seeing in India. A very close market and an Asian peer, which is in this process of the wealth creation journey. We are seeing a lot of trends in India. Share of financial savings compared to physical savings is actually increasing. Financial savings have grown faster and now are 60% of gross household savings. And if you look at which categories in financial savings are growing fastest, it is the categories which actually provide higher returns to the investors, which are mutual funds, direct equity, and so on and so forth. Those are the categories which are growing. But that's not all what has happened in the industry. We have seen also a lot of product innovation which has happened in the market. Equity has kind of been democratized through innovation on products like SIPs. Equity returns have continued to outperform compared to real estate, compared to gold. Over a 10-year horizon, they have really given a lot of returns. But that's not it. There are many options which are also becoming more and more mature in the market, for the high net worth individuals. Whether it is private equity participation, real estate funds, infra funds. So a lot more options are available, and the market is really maturing when it comes to investment options. And as a result, what we've seen is that over the last 20 years, while developed markets like US and UK have doubled or tripled the wealth of their population, India has been able to grow it 16 times over the same period. And the market has not just matured in terms of size; it has also matured in terms of its behavior. And this one example of how our securities markets have moved from trading securities over phones and branches to actually moving to web devices, and companies and business models which have not existed 10 years back have come and disrupted the market. And the example of a company like Zerodha, which was founded in 2010 and today is the largest brokerage and securities company in the country, has happened. And over the pandemic period, they have grown 100% month on month. Why? Because they have been able to address it in a manner and to the audience which has played when COVID has really hit. So it's not just the market improvements, but also the behavioral patterns which have changed in the market. So what has it really taken to develop investment markets? And again, taking cue from what has happened in India over the last couple of years. The first thing that we have seen is the regulator has played a very important role in deepening the market. The regulator is being very consumer-centric. They have taken a lot of measures to democratize participation. They have acted in the interest of the investor and changed a lot of practices where the benefit would really pass on to the investor. That has been one major support pillar. The second has been creating a deep distribution in markets which are highly populated, lots of opportunities. The markets have to be developed by a strong distribution channel. And India over years has actually built a lot of distributors which have trained, which have educated the masses on the importance of investing and importance of investing beyond the traditional savings bank accounts and bank deposits. There are over 100,000 independent financial advisors which are there in India right now, and many more bank branches, etc., which are doing the job. But I think the third is a very interesting thing that has happened in the market. The industry itself has taken a lot of effort and initiative to build equities investing. And this is an example of the initiative which the Association of Mutual Funds Industry in India has taken. It is to popularize amongst the masses, saying mutual funds is the right product for you, right? And there are many campaigns around that, which is really hitting the importance of equity investing in India. So these have been the primary levers around which markets are developing. In summary, it's a very exciting time to be here. Asia is the center of action when it comes to investing, and there cannot be more opportune moment to ride the wave and build a very strong investment industry. With this, I kick off the webinar and hope to have a very interesting and engaging conversation through the day.
Thank you very much. We've just heard from the Managing Director and Partner of Boston Consulting Group, BCG, Mr. Mayank Jha, who was able to help us appreciate many things. One thing is that things are looking particularly good for the Asian region. We were reminded that the Asian investment opportunity is different from elsewhere, and behavior of the Asian market also seems to be different. Now we have a rebound with regard to the stock market, and also mention was particularly made of savings. And that too has seen an increase, an upward movement, and very different behaviors from the earlier crises that were alluded to that reflected the marketplace. So the role of the regulator, we were able to appreciate, also has come into focus, and that is a key factor. So more of that will be in the discussions to follow, I'm sure. Now, with this rebound, banks, how are they going to respond? What about the financial services? How are they going to respond to these things as investment opportunities occur or appear to develop here in the Asian region? We're not only speaking about Sri Lanka, but right now we are going to be able to listen in on a conversation, which I must say was pre-recorded, but is made available to us now. And we are delighted to be able to host Mr. Ajay Banga, who currently serves in the chair of the International Chamber of Commerce, one of the largest chambers of bringing in together all industries from different parts of the globe. And in fact, his association with ICC is over a long time. He was the first vice chair of ICC in the year 2018. And in his professional realm, he is the executive chairman of MasterCard and a member of the board of directors of that organization. And prior to MasterCard, he served as the chief executive officer of the Citigroup Asia Pacific region and served as a member of President Obama's Commission in Enhancing National Cybersecurity. And he was a past member of the US President's Advisory Committee for Trade Policy and Negotiation. He's also a member of the board of overseers of the Weill Council Medical College, and is the director of the Dow Inc., a member of its compensation and governance committees. So for the next 20 minutes or so, he will be in conversation with Mr. Dinesh Virakodi, who serves as the chairman of ICC Sri Lanka. Here we go.
Hi Ajay, great to have you on this webinar. Let me start by asking you what your prognosis is for the world economy for the next 6 months.
Thank you, and Dinesh, and thank you for having me, and greetings everybody. It's wonderful to get a chance to connect with the community in Sri Lanka. Look, I think we are living through a really difficult time in a number of countries, and while I'm relatively optimistic about the United States today compared to where I was, let's say, 6 months ago, because the spread of vaccination and the opening up of the domestic economy and the level of fiscal and monetary injections that are going in, I have a relatively good view of where the US economy will go over the next couple of years. But that's not uniformly the case around the world. And we've got disparities between developing countries and developed countries, and even within developed countries, a lot of disparities based on the spread of vaccinations and the relative opening of the economy. So I think this is a challenging time, Dinesh, and we must understand that. Now, the second aspect is that what has happened during the pandemic is that digitization has become a common word for everybody. Digital usage, the acceptance of digital technology has become a big part of what we're all doing. Look at us talking today. You would rarely have thought of doing something like this entirely remotely, but we are. And so that seems to have become our new normal. Although, as I can see in the US with opening up, people are very quickly coming, the pendulum is swinging back to somewhere in between on physical versus digital. But it's there. Coming with this is a digital divide. And I think we've got to be careful about that, a K-shaped recovery, where if you're an SME or a student who doesn't have access to the broadband or infrastructure or affordability that comes with the internet, you are creating a fairly long-term challenge for equity in an economy. So I think I'm optimistic about the economy. I'm optimistic about the recovery. I'm a little worried about this digital divide. And then the last point, and then I'll move on from this, is my concern about what has been exhibited in this point of an absence of global leadership. It really became everybody for themselves in the pandemic. And the Bretton Woods institutions didn't work. The global leadership didn't work. G7, G20 didn't really work that well. I think that's a problem. And we need to think about what comes next and how do we navigate through this next period, because the global institutions need to come together. This is not the only pandemic that we will go through. So I think those are the three little things that we need to watch out for.
Thank you. Given the importance of Asia, what is your take on the investment climate in Asia post 2022?
Well, I think Asia remains just mission critical. When you have a continent which, if you go all the way from Japan to India, is home to half the world's population, basically, give or take a little, right? And is home to very large, sort of economically sound markets, China, ASEAN, the developed countries of Australia and Japan. This is not markets in a powerhouse growing in India. These are markets that the world ignores at their peril. So my sense is that if we can get vaccinations to become adequately available across the Asian system over the course of the next 6 to 12 months, and I'm beginning to be a little more hopeful now with the commitments of the G7 to give a lot of vaccinations into the world. And as you know, the MasterCard Foundation has made a pledge to put in 1.3 billion into Africa. So private companies, governments are all beginning to step up. I'm generally optimistic about Asia in 2022. I think 2021 will remain a little choppy because of these challenges we spoke about at the beginning.
Thank you. Moving on to your company, what are companies like MasterCard doing to reinvent itself? And my next question is there any other frontiers for credit cards?
Yeah, well, so first of all, I think there's a long way to go for electronic payments, your second question. And it's connected to the first one. We don't care whether you pay with a credit card, a debit card, a prepaid card, or you pay with a bank account, or tomorrow you pay by rubbing your fingers together or looking into my eyes and some technology makes it happen, or you tap your forehead. I think people get all excited about the form factor. But the actual point is not the form factor, it's the enabling rail. And the enabling rail is the idea of connecting billions of people with millions of merchants, with tens of millions of businesses and governments, and enabling the payment system to work. That's the MasterCard that we have been migrating towards. It's called card because it's in our name. But Apple has Apple in its name, and it doesn't sell apples. So what's in a name? And that's the main thing here. So really what we are is in the payments business, account to account movement of money in a safe way, in a simple way, in a less friction way, and then using the data that is generated from that to provide value-added services in cybersecurity and data analytics. That's the company that's being reinvented. I know I've been CEO for 11 years, and I just stepped down to become executive chair and handed over to a terrific guy called Michael Miebach. And you would find when I joined the company, we had a market cap of about 19 billion. It's now 360 billion. And I'm very optimistic about the future. Very.
Can you talk a little bit about people and talent, the impact the pandemic has had on people and talent in general?
Sure. I think the biggest problem with the pandemic has been twofold. One is the unequal impact on women and minorities. So if you were to look at the United States, for example, a lot of the small businesses that got impacted were owned by women and minorities because they were in hospitality, services, restaurants, trainers, theater, the roadside coffee guy, the barber. These are typically not run by other people than minorities and women. And a lot of the people they employ in these industries were also women and minorities. So there is a disproportionate impact on them, which I think is a real problem. It's part of the issue of the K-shaped recovery that we briefly referred to in response to your first question. But I think the second part has a great deal to do with when people say you could work from home. Well, half the American jobs don't work from home. If you're a hospital provider, or you're a policeman, or a fire brigade guy, or an EMV technician, or a computer technician, or a AT&T employee, or somebody of that type, or the Metropolitan Transport Authority, or a pilot, or FAA, you went to work. FedEx, UPS, Amazon, Walmart, you went to work. So when we say you could work from home, we're only talking about the educated knowledge worker, which is only half of the population of workers in the United States. So first of all, that itself tells you that it's not an equal world. And of the 50% who are able to work from home because they're in the knowledge field, the level of stress that you see on them because of working hours, the interspersing of home and office, the separation of home and office went away. So in some ways, while they found it convenient to work from home, you could work in your sweatpants and you could be a little more flexible. In actual fact, their days got backed up by one Zoom call after the other. And as you know well, a lot of young people are complaining of fatigue, are complaining of stress, and companies like ours that have set up mental well-being lines, the number of calls coming into our mental well-being lines went up. We instituted policies of Zoom-free days, meeting-free days, telling managers to give their employees gaps between meetings. So there's that aspect. The third aspect has to do with all these young people who went to college and were graduating in the period of the pandemic and finding new jobs. Can you imagine finding a job where you would never go to work for a year, but you don't even know anybody, and the only way you get to know people is on Zoom or a video call? That's not the way to build a network. That's not the way to build a social system. That's not the way to get imbibed into the culture of a company. That's not the way to become part of the family. And so I think, there were some aspects of the way we managed through this that were very flexible and very good for people. And then there are some difficult aspects. And my belief is the pendulum has swung too far. And as we are able to go back to physical work, hopefully we will come to a better place where we are more flexible as employers than we used to be, but we are not at the extreme where everybody's working at the end of a computer screen.
Excellent. You talked about a leadership deficit. What are your expectations from global leadership?
My expectations is they actually do their job. We voted them into their jobs because we expect them to provide us with the leadership. They should do their job. One of the things they have to do is certainly to look after their countries and their populations, but also to make for a better world for us and our children. How do you plan to tackle climate change without global cooperation? How do you plan to tackle the revival of global trade without global cooperation? How do you plan to tackle supply chains without global cooperation? The development of vaccines in a record time for COVID-19 would not have happened without global cooperation. How do you plan to deal with future pandemics and other such issues without global cooperation? And I think, therefore, the global system, multilateral system, the Bretton Woods institutions, they have defects. The WTO has defects. So we don't want to just recreate the old WTO. We want to create the WTO that is appropriate for our new world of data, of digital, of interconnected worlds. Young people don't look on boundaries as the boundary of their country. The boundaries for them are the boundaries of social connection. And Dinesh, we need to give them the right to their life and their world. And so my expectations of leaders is lead, show that vision and show that capability.
There was a bit of concern about the role of multilateral institutions also in the pandemic, especially IMF. Any thoughts around that?
It's not just the IMF. The IMF actually came forward with some degree of assistance, but the WHO faced struggles, right? People lost faith in the WHO's clarity of thinking. So they are now trying to build it back. So I think almost every institution of global cooperation came up short in the pandemic, partly caused by failures of leadership there, but partly caused by the failure of large countries and important countries to agree on the basic principle that we are in this together. It's an interconnected world. I cannot be safe if you, Dinesh, in Sri Lanka are not safe. It's not enough for me to do just what I want in America, because mutants and variants will come from elsewhere. I need to make sure that you are healthy and prosperous as well. We're in it together, right? And I think that's the principle that somehow needs to come back to our global leadership.
Thank you. Talking about ICC, there's a lot of talk of making ICC relevant. In terms of expectation, what is your agenda for ICC going forward?
Well, my view of the ICC is that it plays an incredible role as the merchants of peace. And because trade leads to peace. When countries trade, they don't fight. When people trade, they build relationships. And relationships is equal to peace and prosperity. So now, not everything was done right with trade. The beneficiaries of trade did not look after those who got hurt. That's a mistake. Should we have done better with retraining, with social safety nets, with new kinds of roles and opportunities and jobs? I don't think we did. But trade did reduce global poverty quite dramatically over the last 30, 40 years. And so I think the ICC's role, first, is to help to grow the economies again. We've been through a very challenging period, and that means we've got to get vaccines out there, because without vaccines, how will economies grow? You cannot open. And therefore, equitable distribution of vaccines and the effort to get vaccines into people's arms around the world is mission critical, which is why the ICC is doing so much work on a vaccine clearinghouse, as well as with COVAX and WHO and all that. Second is to help to revive global trade. And I think there's far more challenges, two types principally. One is there's a lot of local and bilateral and regional trade deals being enacted. Now, in a way, that's not bad, provided we as members of the ICC engage with those to ensure that business is well represented when people are deciding on those trade deals. But too many regional and bilateral deals make it very hard for SMEs, Dinesh, to do global business. An SME does not have 54 employees who can change their product to suit a small change in every country. SMEs need standards, because standards create level playing fields. And level playing fields allow SMEs to do what they can do, which is make a good product and distribute it. They don't have lawyers and engineers and CFOs and treasurers, and they don't have all that. So this is a problem of balkanization of trade, which means we must help the WTO come back to some form of future prominence over the next few years. Now, hard, not easy. Ngozi is a wonderful person to be there, and we're engaging with her, as you know. But we need to get a few things done. The fisheries deal, e-commerce deals, get some quick wins, and then really work on the necessary reform in the WTO that is needed for the future of trade. And that brings me to the future of trade in data and technology. I think we need a data and technology forum, like a board of some type, comprising the regulators and leaders from the top countries of the world, so that we don't make mistakes in the future of data and technology. We cannot afford balkanized technology and balkanized data, just as we cannot afford balkanized standards in my earlier comment. Now, in the past recession, we created the Financial Stability Board of the G20, which has enabled the big countries of the world to work well together on financial systems, which is why, if you notice in this crisis, fiscal and monetary policy worked pretty well across the world. It's not by accident. It's by work and effort of the FSB. We need something like that for data and technology, maybe a data and technology board at the G20 level. I think the last part, which we cannot ignore, you feel this in a country like Sri Lanka, we cannot afford to ignore climate change. We must advance sustainability. And as businesses, it is incumbent upon us to do that. So if we're going to have new standards on ESG for big companies, the big companies are only as good as their SMEs and their supply chain. So we've got to find ways to enable SMEs to keep pace with the idea of sustainability, which is why the ICC is doing a lot of work on its climate hub and SME 360X tools that allow SMEs to be climate and sustainability compliant. So those are the three. Do something about economic growth, help to work on trade, digital and regular trade, WTO institutions, that type, help SMEs, and then really get into the sustainability chart.
Okay, thank you. I have three quick questions to close this conversation. Moving on to banks. Banks are facing fierce competition from fintech and tech giants like Amazon. What should banks do to stay relevant going forward?
Well, I think banks have to be willing to compete. They can no longer, if they believed that in the past, they can no longer believe that because they have distribution and they have balance sheets, they have strength, that they have a walled garden. They have no walled garden. Regulators are opening up the walls. And so banks have got to compete with fintechs and with retailers. And by the way, they are eminently capable of doing so. You look at banks in every country that are nimble and adapting, they're doing a great job. So, I'm very familiar, for example, you take banks in India, right? Your neighbor. Look at HDFC Bank. Nimble, competitive, digital, enabled, oriented for what the country wants to do. And guess what? It is competing. So my view is that banks can compete, but they have to provide the right capital and resources for technology and really look at the consumer and at their problem and solve that. Now, they need a level playing field with regulators. If regulators make them have a different set of regulations from what fintechs have, that's not fair, right? You have to create level playing fields.
Right. Talk a little bit about how banks can also mine the data and become more customer focused, since that's your area of expertise.
You put the customer at the center. That's how you start, right?
Yeah.
How do you do that? By the data. Remember, banks have enormous information because if your bank account is in the bank, you know how much I earn, how much I spend, where I spend, how I spend. So if banks were to not only use their own data, but cooperate across institutions to be able to share data with privacy protections in a way that enables for better delivery of product and pricing for Dinesh, what is wrong with that? That is a good thing. So I think that's the idea of open banking. But open banking cannot be where the fintech and the retailer can take the bank's data. It has to be where the bank can also get the fintech's data and the retailer's data. So you create a level playing field and then may the best company win. The best company wins, the consumer will win.
Talk a little bit about the challenges around cryptocurrencies as well.
Sure. I think cryptocurrencies are of three types. There's the basic asset-based ones, a bit like Bitcoin and others. There are those that they call stable coins, which are not as volatile. They connect them to some form of fiat currency, but they're still private sector issued. And then there's government issued central bank digital currency, which is a digital representation of a fiat currency. And my belief is that currencies that are volatile and floating, they're not really currencies, they're asset classes. And if you are a sophisticated investor, well, then go ahead and invest in them, but know that you could lose all your money as well. And that it won't only climb. As you can see, Bitcoin's prices go up and down quite volatile. I think ultimately central bank digital currencies will have a real role to play in enabling the digital ecosystem that consumers are migrating towards. So somewhere over the next few years, some countries are already adopting them, others need to get there. What we have done as a company is we have laid out certain principles. First principle, it must be stable. So the consumer must be protected. Second, it must meet all regulatory and compliance rules in a country. A currency, if it does not meet the needs of the country's government, that is not acceptable. And third, it must have protections for the consumer. Consumers are used, when they pay money today, they're used to being protected from fraud. They are used to having chargeback rights. They're used to having dispute settlement rights. They're used to data privacy. They think all this when they make their payment. Cryptocurrencies have to satisfy those needs. If you satisfy those needs, we will do business with you. We already enable some cryptocurrencies to be converted to fiat currencies and run on our network. We're examining other cryptocurrencies to run on our network directly if they meet these criteria. And we are working with central bank digital currencies in a number of countries to enable them. Our company is today the single largest holder of patents in the space, in the payments industry. So, we are putting our money where our mouth is, right? So investing in it.
Before I get to my final question, I have another question for you. What really keeps you up at night?
Two things mostly. One is everything to do with cybersecurity. I think that for the world to become more digital, for the world to become more electronic, for the world to prosper from the Internet of Things, and for the Internet of Things to enable the unbelievable visions of medical care, education, access to products that we think it can provide, that all depends on trust, Dinesh. And if cybersecurity breaches, and you can see ransomware attacks all over the world, you can see people breaching companies for data. If those continue, trust will evaporate. And if trust evaporates, people will not adopt this. And so my belief is that cybersecurity and therefore trust is really important. And right now, cybersecurity and ransomware is like the coronavirus pandemic. People still are not taking it seriously enough. In the early days of the pandemic, they did not. They all thought it would go away. Now we are all taking it very seriously. Well, let's not do that with cybersecurity. Let's take it seriously right from the beginning and work hard on it.
Great points. Finally, my final question to you is, what is your message to the regulators and in general to retail investors going forward?
Well, it depends what perspective. I think if the perspective is around investing, my view is that you should be confident about the fact that the world economy will come out of this. I think central banks and regulators are actually doing a terrific job of navigating the fiscal and monetary policy challenges of the last year. Now, some countries have a bigger war chest, they can do more. Others have less money in the bank, they can do less. So while they are trying and they're doing well, we need to find a way to create global cooperation where countries that don't have the same ability to have the same fiscal and monetary depth are assisted by global institutions. Otherwise, we will end up with a further inequality in the system. And that, to me, Dinesh, is not acceptable. So my advice is be confident, but be compassionate.
Thank you. Thank you, Ajay. It was great talking to you, and I look forward to welcome you in Sri Lanka at some point. Thank you very much.
I would look forward to it. Thank you very much. Good luck and be well and stay safe.
Thank you.
Thank you. Bye-bye.
Thank you.
How do you manage your financial data? Think about your current tool for a minute. Does it eat up time? Is it slow? Does it feel antiquated? Do you get a headache from confusing spreadsheets that are prone to errors? LucaNet, that's the knowledge financial experts really need, and the ability to put this knowledge in a simple software program. That's why LucaNet offers the all-in-one solution for consolidation, planning, reporting, and analysis. Everything for your numbers from a single source. A solution you can quickly begin using and that delivers all the data you need at the press of a button. That is so intuitive, you can get started without any IT skills, and that you can use to manage your company transparently. Consistent, comprehensible data for everyone that you can rely on. So you can spend your time on analysis and strategies in order to make the right decisions. And we're there for you whenever you need us with technical and financial accounting advice. No matter how complex your structures or requirements, you're always on top of things with LucaNet. And you can handle your growth. Speaking of growth, the LucaNet family is getting bigger too, as a member of the worldwide network of partners. The headquarters in Berlin and the company's other locations are driving worldwide growth. Even with this dynamic growth, 3 things are just as important to LucaNet now as they were back in 1999. The passion and customer focus of an owner-managed company, the reliability of a certified vendor, with software that is made in Germany, and our mission of making complexity simple. Today, we're already a partner to more than 2,000 customers around the world. We're the partner that helps you focus on what is most important. Simply intelligent. LucaNet.
That was a message from Global Frontiers. That's our sponsor of this very special webinar. And at this moment, I would like also to say, in acknowledgement and thanks as well, that our internet service provider is Lanka Bell. Thank you. So we have had the benefit of listening to one of the leaders in business as the head of the International Chamber of Commerce, which is the largest trade chamber in the world. And it was good to be able to hear from Mr. Ajay Banga. Now to our panel discussion, which again brings many minds on this topic of the opportunities for investment in Asia. Of course, Sri Lanka is in Asia, but Asia, the larger context. And our panelists are Dr. Indrajit Kumaraswamy, hardly a name that is not known. He's the former governor of the Central Bank of Sri Lanka. We have Professor Keith Carter, who's the associate professor with the National University of Singapore. We have Mr. Dumit Fernando, who's the chairman of the Colombo Stock Exchange. Mr. Thilan Vijayasinghe, a former chairman of the Board of Investment, or BOI, of Sri Lanka, and chairman and CEO of TW Corp Private Limited at the present time. Then too, we have the chairman of NP Capital, Mr. Nimal Pereira. Mr. Romal Shetty is the president, consulting with Deloitte India and South Asia. Then from the group investment of AIA Group, we have market economist, Mr. Urvi Liavor. Then too, from UNSCAP of Asia Pacific region, Mr. Eric Roda, and Mr. Saman Wimalaratna, who is CEO of DCS Singapore Limited. And to take this conversation forward, our moderator is the chairman of KPMG for Middle East and South Asia, or MESA area, Mr. Riaz Mulla. So Riaz will hand over proceedings to you.
Okay, thank you, Arun. We just have a little over an hour and 10 minutes, and let's see whether we can get as maximum input from the very illustrative panel that I have. So we have a great panel, great balance in the panel, and I have some questions that I've set out, and hopefully I might get views from more than one panelist for some of the questions that I'm going to ask. All right, so I'm going to start off to just set the scene for the conversation. I'm going to ask Indrajit Kumaraswamy, former governor of Sri Lanka, very distinguished job he did there. And I'd like to ask him, Indrajit, what do you think are the causes for the rising of global debt?
Greetings to everybody, and maybe in the interest of transparency, I need to disclose that I'm on the board of Linear Wealth Management, which is an equity manager. and any increased demand for Sri Lankan equities will benefit Linear. So let me make that disclosure. Let me, to answer your question, Riaz, I think it's important to differentiate between the sovereigns, the corporates, and households in answering your question. And the most eye-popping numbers are related to sovereigns. And I think that has been an inevitable process. Governments have had to use fiscal policy to save lives, to save livelihoods, to protect poor household incomes. In fact, advanced countries on average have had a fiscal stimulus of about 15% of GDP, emerging markets about 5%, and other developing countries about 2 to 3%. So there have been these large fiscal stimulus packages to support very high outlays on healthcare, that's PPEs, medical equipment, therapeutics, and now vaccines. And then at the same time, they've had to have income support schemes to support furloughed workers. They've had to increase welfare payments to support low-income households. So if you take all these things together, there's been an inevitable severe elevation in public expenditure. And on the other side, there's been some deferment of tax payments. On top of that, the contraction in the global economy and the contraction in individual economies has inevitably led to a reduction in revenue. So you've had expenditure going up sharply, revenues falling sharply. And the financing need requirements that came up had to be met through increased borrowing. And that's why you've seen this massive increase in sovereign debt. But there are at least one important mitigating factor, and that is the historically very low interest rates. So though the stock of debt has gone up dramatically, it has not translated into debt servicing in the way it would have done if interest rates were at historical levels. But all the same, there has been a massive buildup in debt, and eventually it will have to be managed. And we are already seeing concerns emerging about that. For instance, you're seeing the discussion start in the US in particular, but elsewhere as well, about the fairness in terms of burden sharing, in terms of tax. That you saw the tax declarations of billionaires illegally being disclosed, and there is a discussion on wealth tax. And I think there is a push that there should be the principle of affordability, that's the capacity to pay, should guide the tax measures that are going to be taken to pay for all this. And also another part of this whole piece is the international agreement that is emerging on a minimum corporate tax. I think it's 15% is what the major countries have agreed upon. Interestingly, the US, Janet Yellen is very much in the lead. The US Act, this is not a new idea. It's been around for a while. The US resisted, but now I think because they've decided they need to spend a lot of money to retain their competitiveness as a global leader, I think they've now come to the conclusion that this is a worthwhile exercise. So these are some of the things that are going on. And I think going forward, as I said, hopefully we are seeing the light at the end of the tunnel, and that the debt hole will not increase too much further, but we're going to have to manage it. And it'll have to be managed in a way there is fairness in the way the burden is shared. As far as corporates are concerned, I think here the story has to be differentiated across sectors and size of company, etc. As Mr. Bangra said, no, I'm sorry, Mr. Jha, I think at the beginning, global wealth has increased, right? But disparities have increased as well. So those companies which are in the space where you have seen an increase in economic activity during the pandemic, like the tech stocks, the whole stay-at-home stocks, etc., those companies have done well. And in fact, they have strengthened their balance sheets. But companies in sectors such as travel, leisure, hospitality, entertainment, those sectors where there is person-to-person contact necessary and dense person-to-person contact necessary, those have done very badly. And those companies, I think, probably have had to leverage up to meet the cash flow requirements. They've probably restructured and they've probably trying to survive, basically. But where there has been probably a pretty devastating impact is in the MSME sector. I think those companies, I think there are lots of small businesses, micro businesses around the world, which have probably gone out of business. So how do we get out of this? Clearly, a V-shaped recovery, a robust V-shaped recovery would help. It would kind of lift all boats. But at the same time, I think probably it would be necessary to prop up some sectors. But what is crucial is to learn from the lesson from Japan in the 1980s. And that is not to prop up zombie companies. Because if companies are unviable, sadly, you have to find some way of letting them go, because it leads to a misallocation of resources, which then acts as a big drag on growth and development and employment going forward. So that's what I'd say about the corporates. Households, again, it depends where you are on the income distribution. We heard that savings have gone up. If you're at the upper end of the income distributions, your income streams have been largely protected. You work from home, you haven't lost your job, and you haven't been able to spend your money because you've been locked away, and therefore savings are up, and you are certainly, you may even have deleverage, far from leveraging up. People, again, at the bottom end of the income distribution, again, would have run into trouble. They may have had to sell their assets. They may have had to borrow from the informal market at very high interest rates. So, I mean, I think it's too early to have any data to be conclusive about these things, but I'm sure that's where you will probably see leveraging up and a lot of hardship. And after 20 years of continuous reduction in poverty, continuous reduction in malnutrition, we are now seeing an increase in absolute poverty and increase in malnutrition. So let me end with that.
Yeah, but I'm going to probe a little further, trying to take advantage of your term as central banker as well, as past central banker. Do you think that central banks can use the traditional policy or policy instruments in the current pandemic situation, or will they have to think outside the box?
I think
to manage it.
Sure. I think they can use their traditional instruments. They can use their traditional instruments in unconventional ways, and they can use unconventional measures. So I think if you look around the world, you see evidence of all three of these things. People have used monetary policy in the orthodox way. They've brought interest rates down, but it's unconventional in the sense that interest rates are at historically extraordinarily low levels. And you've even had the situation in some countries where nominal interest rates have been negative. So basically, you're paying the bank to keep your money in such situations. So that, in that sense, it's unconventional. It's monetary policy, conventional monetary policy, it's interest rate policy, but it's been used in an unconventional way. And similarly, if you take the statutory reserve requirements, they're at historically very low levels. So conventional instrument, but at an unconventional.
Recording stopped.
At an unconventionally low level, the requirement, the ratio to create liquidity at this time. And open market operations, again, you've seen.
Recording in progress.
Open market operations where, central banks buy government securities to infuse liquidity into the system. Now, again, you've seen one or two countries use it in an unconventional way, where they have bought securities at the longer end of the yield curve to suppress long-term interest rates. So as I said, they're using the conventional methods in an unconventional way. So what are some of the newer things? I won't say they're very new things. These are things that emerged during the global financial crisis as well. And that is this very large asset purchase program. But this time around, the depth and breadth of the asset purchase programs have been larger in the major countries. So the volumes in terms of the assets that are being purchased, the breadth in terms of the types of instruments that are being purchased have all increased during this period. So, and the central banks have also supported these measures with regulatory forbearance and macroprudential measures, which have supported the monetary policy measures to ensure that the accommodative monetary policy stance is supported. Final thing let me say is that in some countries where governments have not been, and this applies to our country, where governments have not been able to raise the money they require through domestic and foreign issuances, bond issuances, the central bank has had to monetize the deficit. And sometimes where there has been severe lack of fiscal space, it has had to do it to a very large extent. So is that a problem? As things stand, no. Because you look at, I like to use the example of a glass. If a glass is full of water, if you put more water in, it spills over. But if the water is poured out, you have space to pour water in. And that's what has happened really, in the sense that there's been a destruction of aggregate demand because of the pandemic. And therefore, the central bank pushing liquidity into the system does not lead to overheating of the economy. So there is considerable scope to do that. And the modern monetary theories say that you can do this pretty much ad infinitum without getting into inflation. And I think it is true. We're living in a low inflation world because of two things. One is technological change, which is pushing down costs. Two is the competitiveness in the global economy. Both these things have had a suppressing effect on inflation. And therefore, even when there's been loose monetary policy, inflation has not really gone up because the pricing power of companies has been reduced through, costs have been cut through technology, and pricing power has been reduced through competitiveness. Now, going forward, probably you're going to have even more technological innovation with the fourth industrial revolution. Competitiveness, I mean, globalization at one point seemed to be under fire, but I think it's now settling down, and I don't see any significant reduction in competitiveness in the global economy. So inflation will be low. So can we say in Sri Lanka, keep doing this? Just printing money? We have a problem. We are a country with a persistent and structural deficit in our current accounts of the balance of payments. And because there is a high propensity of additional liquidity in the system to flow through into imports, we run into balance of payments problem. So that is the limiting factor for us. It hits the balance of payments because inflation, we may have transitory inflation. People are talking about transitory inflation because of the base effects of very low inflation over the past 15, 16 months, because of the supply taking time to catch up with the boost to demand, which comes through release of pent-up demand, and also supply bottlenecks in areas like automotive chips and semiconductors, etc. So there are these supply side effects which are transitory, and monetary policy can't do anything about it because it's interest rates, and monetary policy really deals with demand. So the supply side price pressures have to be resolved by tackling the supply bottlenecks. But if inflation remains high, what we call transitory inflation remains high for a while, then inflation expectations change. Wage demands come in. And then, of course, you get demand side pressure again. And at that point, you have to respond. So really, you have to be driven by the data. Our central bank has very good people. We have there's a model, there's analytics, and the central bank needs to be data driven in terms of how it handles its monetary policy. Let me stop with that. I've taken a lot of time.
Okay, yeah, I know. Okay, all right. I'm going to ask Professor Keith from an academic point of view, to give a quick response to the sentiment that were expressed by Indrajit just now. Keith, would you like to give your quick response from an academic perspective?
Absolutely, and what a wonderful overview that's been given. Thank you so much, Doctor, for sharing. In terms of the economic as it looks like now, I keep going back to the 1920s and just looking at a couple similarities that we have. As the doctor and the past chairman of the Reserve had just shared, there's an issue in terms of taxation, and there was significant discussions around taxation in the 20s. there was an issue around significant changes in jobs. We went from agriculture to industry, from horse and buggy to mechanics and more. We were installing telephones and electricity into our manufacturing plants. You've all been talking about data, right, as one of the key things. The internet and so forth are here, but in a bigger way. Earlier, the past speaker shared about how people around the world have now access to and reductions in poverty. And we were just beginning to see the inklings of the finishing of the First World War and the beginnings of what might be the second. And so there's so many connections between that. We're very blessed to be in this generation to see a transformation like this. The key point I would say is, as investors, we have to look very carefully at what was mentioned earlier, fairness, because if we become too greedy, we get burned. If we try to hold all the cash and don't invest it back into the economy, back into the society that surrounds us, then, and if we have a castle on the hill, be ready, you will be stormed as poverty and the distance increases, as the previous speaker had been on. So critical for great minds like all the people on the panel here and those who are listening to really take a very careful look at what Dr. had just shared, that we need to make the right policy choices. We need to look at taxation in the right way, not to stagnate business. Interest rates will probably increase. So how do we make sure that the cards all don't fall off the table because of that?
Yeah, thanks, Kate. Thank you for that quick intervention. You teed up an interesting point. We talk about investment decisions in the past, was purely risk return, and we stopped there. But now, when we talk of investment returns, people are now talking about environmental, social impact. All of these are now very important considerations when people take investment decisions. I'd like to turn to Eric. Eric, can I ask you to give your thoughts on this phenomena, which I think is very relevant now, particularly among the young people who are no longer prepared to just listen on just risk and return, but have a lot of consideration about environment, social impact, etc. Eric, over to you.
Thank you. Yes, looking at ESG, which is environmental, social, and governance, that has become that's a criteria for it's increasingly popular for investors to evaluate companies in which they might want to invest. That means the criteria can help investors avoid companies. And
Eric, you're coming through a little too quietly. We might need to increase your speaking volume. Thank you.
Okay. Okay, how is that? Can everyone hear me?
Yeah, better.
Okay, sorry for that. No, going back to ESG, which is environment, social, and governance, I think younger investors particularly are more apt to look at investing in companies that do not pose a greater risk on the environment or other practices. And what does that mean? For instance, if you're interested in investing in hydropower and you're looking at the company that's behind it, is this company that's going to build this dam, are they going to take into account, for example, what's behind the dam, which is the catchment area, the forest area, for example? If they think that it's okay to cut down that forest and sell the trees, then they make a big mistake, because the catchment area is the watershed, and if you cut down the trees, then the silt is going to back up into the dam, and the intake valves of the dam will be blocked. So, sure, when you want to invest in a company that really looks at all the environmental issues, not just because you care about the forest, but because it's all integrated. And also, do you want to invest in a maritime shipping company, for example, that is now dumping toxic waste and garbage off the coast of Colombo? I don't think you'd want to do that. So you want to invest in companies that are corporately, socially responsible as well. So I think the environment is critical importance.
Okay, thank you, Eric. Dumit, I'm going to turn to you. I think a lot of speakers have talked about that the key to survival in the new normal is to effectively leverage the interrelationship between risk, return, and impact. which is now talked about quite a lot over the last few minutes. What do you think about it? Do you think it's true? And if so, what are your thoughts on this? As the chairman of the Colombo Stock Exchange, I'm sure you'll have some interesting thoughts on this. Over to you, Dumit.
Thank you, Riaz, and greetings to everyone on the webinar. I will start by focusing on one word you mentioned in that question, which is whether this is the key to survival. So I think I can approach that in two different ways. I think if you're asking the question from the point of view of the planet, I think absolutely. Because what we do in terms of investment and what we use our investments for is very much going to define how the world, our businesses, our economies, our countries, our society, our nature evolves over the next several decades. Then I guess the other way to look at this is it essential, or is it essential for the survival of the investor? I think if you take a very short-term view, many investors might think the only criteria I need to worry about is my narrow financial return. But you know what's interesting now, as Eric touched on earlier as well, particularly the younger population is starting to believe that survival for them is not purely financial. It's about all of the ESG factors, starting with the planet. And there are interesting statistics. You know, there was a recent Capgemini survey which looked at high net worth, assets around the world. And in Asia, 16% of people, high net worth people over the age of 60, had an interest in investing in sustainability related investments. However, over 40% of those under the age of 40, under the age of 40, were keen on investing in sustainability related investments. So that tells you that there is growing consciousness among the younger population, among millennials, on sustainability related investment. Now, I think part of your question is also about this interrelationship between risk, return, and impact. Now, you know, traditional portfolio management theory suggested that you have this risk return curve, and then what we call in financial terms an efficient frontier in the balance of those two. So that was the easier way to describe that is that was a pretty two-dimensional curve, right? You had on your y-axis you had return, on your x-axis you had risk. So what's effectively happening now is you're creating a three-dimensional curve for that efficient frontier, and that third dimension is impact. And it is essential for us to be able to measure that third dimension to really think about the total return. So it's sort of like impact investments have a balance sheet return and an off-balance sheet return. The balance sheet return we can quantify in terms of financial return, and then there's an off-balance sheet return. And the only problem with that right now is the fact that it is not entirely quantifiable. And it is not quantifiable in a common lingo. And therefore, it gets often confused with whether there is actual impact or not. And the ability, particularly in terms of investment managers, it becomes very difficult to measure the impact of investment managers because if you're measuring them on financial return, it's very easy. If you're measuring them on financial impact plus the return on this off-balance sheet item, which is impact, it's so much harder. So, the answer to your question is, yes, I think it is essential for survival. It is essential for survival without doubt for the planet. I think for the investment industry, it becomes essential for survival as and when those who are your end customers, start demanding that more of you. In the past, if you were demanded, if you're an investment professional and your customer demanded a high return for your survival, that is shifting. With millennials in particular, that objective or the target that's been placed on the investment industry is shifting. You saw BlackRock, the world's largest investment firm, which manages, I don't know the latest stats, probably $7 or $8 trillion worth of, trillion with a T, dollars worth of investments around the world made a huge push into sustainability. That there are many global professional investors have followed suit. And I think you will see that evolving, you will see that growing. And for a lot of the number of reasons, clearly for healthcare reasons, I think, Ajay Banga explained very clearly why it matters that a virus in some, far off country is relevant to us. Similarly, I think one of the biggest issues facing the world in the future is inequality, whether that's gender inequality, and primarily economic inequality. I think to be able to address that through ESG metrics is essential. Clearly, climate change and related initiatives, which I don't need to go into. Now, coming back to just the final point I want to make, Riaz, on stock exchange perspective. For listed companies, we have been an early adopter of the Sustainable Stock Exchanges Initiative of the United Nations. We have strong guidance on sustainability reporting for our listed companies. Now, these are at the moment being done, I would say, still on a somewhat voluntary basis, because companies are given guidelines but not requirements on this. But I think that will evolve. What you're seeing in other more mature markets is the investor is demanding this. The investor, whether these are active funds or even individual investors, they're demanding that. And I think you will see that evolving, particularly as Eric touched on, as the younger generation of investors start becoming more active with these concerns in mind.
Yeah, thanks, Numit. That was very, very useful. I mean, I think the key message that's coming out is that ESG is no longer nice to have. It is now becoming a must have. But I think the challenge for the finance industry would be to come up, as you mentioned, standardized measures so that, you can measure investing managers on their performance, not just purely on the return, but also on this ESG aspects as well. So I think that's a work in progress, and I think we will see greater progress over that. I'm now going to move on to Saman. Saman, if I can ask you, do you see any changes in investing trends and instruments in Asia in the last decade? And particularly, I'm giving you actually a double-barrel question. Firstly about in the last decade, and what about the last year with the pandemic situation? So the first part is I'd like you to know what are the changes you see in the trends, investing trends and instruments over the last decade in Asia, and then maybe the second aspect, what do you see the last year with the pandemic situation? Has that caused a change in the trend? Saman? Saman, are you on mute?
All right.
Evening, Riaz.
Okay, sorry. Yeah, I can hear you now. Go ahead.
Yeah, I warmly welcome everyone to the event. So basically, there are many trends that I would like to share, but I thought of sharing 4 key trends which will continue to the next decade too. The first being that the growth in the Asian PE market, the private equity market, where if you take last 5 years, like from 2016 to 2020, we have witnessed a growth approximately around 60% from 115 billion to 185 billion. That's one of the key trends that I would like to present. The second one would be that focus of venture capitalists on the digitalization aspect of it. Asia is in the forefront of technological development, including fintech, health tech, and clean tech. Since we were talking about the sustainability, that's where the clean tech will come into play. And then the third trend being increased investment in research and development. If you take Asia as a region, the total investment that has gone into research and development in 2019 is little over 1 trillion, to be followed by US with 596 billion, and then in Europe it's 492 billion. So the fourth trend is that region remains the largest source of global foreign direct investment outflows. So those are the 4 key trends that will continue, which I thought of as worthwhile sharing. So in fact, moving forward, there are some other key factors also which need to be considered. So the value chain restructuring that is taking place on the demand side and then on the supply side, especially with the pandemic, that is to build that resilience that is required. And then the next factor that we need to take into consideration is that, as my peer panelists were talking about it, digitalization of economies. In fact, in Asia, the total digital economy is estimated to be approximately around $100 billion in 2020, which is expected to grow to 300 billion by 2025. So taking the global IPO market into consideration, I think out of 1,115 IPOs that took place in 2019, 50% is coming from the Asian region. So there is an interesting factor that need to be taken into consideration. Technology sector dominates the IPO market in the region with 151 IPOs with USD 25.4 billion, with an average deal ticket size of $160 million, as opposed to the industrial sector, which reported approximately around 7.3 billion US dollars, with 118 IPOs approximately. So other factors to consider are that investment in research and development, as I told you, is a very crucial area that need to be focused on. And then current level of internet users also is growing from 400 million to 750 million in 2025. And e-commerce, if you take the Asian region, e-commerce was like more or less an option. It was coming as an option, not an essential. So with the new pandemic, now the trend is changing where the e-commerce is going to play a very crucial role. So it's becoming an essential. And the new norm has forced the governments, businesses, and the consumers basically to adapt to digitalization. This is where the growth in digitalization and the level of penetration that what we would have experienced in few years to come, we are realizing it now. So, and another interesting fact is that global IT leaders are emerging from Asia, which explains the availability of the right talent in the region. So these are some of the key factors that need to be considered when it comes to changing the investment sphere for the next 10 years, taking the trends into consideration of the last decade. So if you take investors are cautiously optimistic at this hour, investing in education, healthcare, financial services, as my peer panelists explained that, focusing on fintech, e-commerce, and various other digital platforms. So basically, by looking at strong business ideas and plans, the available pool of capital is quite significant. It's worth approximately around $20 billion. So annual value of the total digital payment transactions across the region also will double by 2025 to be estimated to be around $2 trillion. So these are pretty encouraging facts and trends that what we have witnessed in the region, which will encourage the investments, and then basically the investment opportunities, the way it is being presented, also will change. So technically speaking, by looking at the investment opportunities, Riaz, I get to see 4 main investment opportunities. So investing in infrastructure, because for you to promote the digitalization, 5G technology need to come in, so which is like 50 times faster than 4G with the traffic that is being created. So the estimated investment that is required in the region is approximately on telecommunication upgrading the telecommunication infrastructure is approximately around $20 billion. So investment in various platforms such as fintechs and health techs and edutechs, and then as my friend correctly told that, focusing on cybersecurity area too. So if you take 2018, the fintech investments in fintech in the Asian region amounted to approximately around $29 billion, whereas Singapore, it was approximately around $9 billion. So, and then when it comes to this global value chain restructuring, that, robotic business automation is also going to play a crucial role. That's where the investments will be going into robotic business automation, redefining processes, improving the level of efficiency, so on and so forth. So why people would want to focus on in the investment sphere, that why would investors would want to focus on the digital opportunities or the platforms? So the related platforms is that the scalability is one of the key factors. There are no geographical boundaries with these digital platforms, the availability of the market, expanding your horizons, promoting trade, service, and goods both. So then time taken to penetrate into the global space is much shorter. And then team demography is also something that we need to consider, where their level of adaptability is something which is a factor that need to be taken into consideration. So as opposed to brick and mortar industry, if you take in digital space, the opportunities will give the investors to basically realize their investments and then sort of achieve better returns, because the valuations, but the desired valuations, what they are looking at also will be reached with a much shorter time cycle. So when it comes to the instruments that are being used, include safe notes, preferred equity, and then highly structured preferred instruments and convertible debt. So that's how this is going to roll out, Riaz.
Okay. All right. Thanks, Saman. You see, I'm going to turn to Harvey, and Saman talked about the new normal, and he talked about the digital space, and the growth of the digital space, investments into that area, etc. What would you think are the non-normal investment instruments that present an acceptable risk-reward rates that could be used in the current new normal, as someone talked about? Harvey, off to you.
All right. Thank you very much for this very meaningful question. And I would like to answer this question by, first of all, try to define what we mean by new normal. Obviously, technology offers new avenues for investment, but I would say from a financial market investor, I can describe this new normal by three factors. The first one, that was very well illustrated by Dumit, is this growth in impact. And as a macroeconomist myself, I see it as the triumph of economics. Just for the anecdote, when I was still a student many decades ago, I kept hearing about externalities. And in a fully functioning market system, the pricing of any goods or services need to reflect the externalities, being positive or negative. And these lessons concluded systematically that, unfortunately, it doesn't happen. And this broad trend towards impact investment, taking into account ESG, is a return of the externalities into prices, assuming that the whole spectrum of externalities are in the price. So like Eric mentioned, it's not just looking at one specific investment, but also the consequence of the investment that you are going to make is something important. So end of the anecdote. The other element of the new normal is this worldwide low yield environment. That's also something that is defining the current market environment in which we have to invest. And I have to say, if I project myself going forward, yes, there may be a potential for slightly higher nominal yields, especially after the very low levels that we had last year. But the outlook isn't that great. And a return towards where we were, I would say around the 1990s or early 2000s seems to be unlikely at this stage. The last element that I need to highlight is the sort of a new liquidity paradigm. Before the great financial crisis in 2008, market liquidity was primarily driven by the private commercial banking system, so to speak. What the great financial crisis has changed is that market liquidity today is primarily driven by not private commercial banks, but by central banks. And the behavior of these two categories of investors is radically different when it's about risk. When you have risk mounting, the private sector becomes very, very careful and withdraws liquidity from the system. That's what we saw in 2000 with the burst of the IT bubble. That's what we saw in 2008 with the burst of the credit bubble. Now, with central banks jumping in, the paradigm has shifted, and the behavior of the central bank in facing risks is radically different. Instead of withdrawing liquidity, these central banks are adding liquidity to prevent the consequence on the economy. So when you have these elements in mind, then the big picture for financial markets are pretty clear. You need to expect some drawdowns from time to time, but they are going to be short-lived. So this is something that is very important because it makes investing in growth assets the winning bet for any kind of investor. So by growth assets, I mean equities, I mean credit, especially when you go into the higher level of risk, and also some other elements like commodities, for example. Now, I'm not trying to give you any advice on where to put your money, because at the end of the day, it really depends on the nature of risk tolerance by any given investor. The advice we can give to a retail investor is definitely different from the advice that we can give to an institutional investor. For retail investor, if the priority is to maintain a liquid position, obviously the decision will be to go into the sort of highly liquid markets. So the preference would probably go to equities and to a lesser degree to credit, including high yield. But at least with high yield, you can optimize your return. And again, if you bear in mind that central banks are now keen and able to support the market if there's a need to support the markets, the drawdown that may happen from time to time is likely to be transitory, and the rebound is likely to happen. Just look at what has happened over the past 10 years. That's exactly what we have seen. Now, if we are talking about more sophisticated and advanced investors, be it for clients of private banks, for example, or institutional firms like AIA, for instance, the range of investable assets becomes a lot wider. And I would say if we can move to what is called the private assets, so including private equities and private debt, then you've got a very interesting mix of risk management that is enhanced, especially for private credit, with a lot of covenants attached to these private debts. And also for private equities, you've got very nice returns if you can bear the position for a sufficiently long period of time. Then you can enhance the return whilst still taking reasonable risk. So again, with regard to your question, I think it depends on the risk tolerance of the investor, and there is currently a wide range of possibilities. Just to conclude, I think the private assets are the kind of investments that are going to gain in popularity going forward, given the fact that with the accumulation of wealth, we are now observing some private debt funds, for example, growing in size and offering alternative sources of funding for entrepreneurs. So again, private assets are something worth considering.
Okay, thank you, Harvey. I'm going to now ask a question from get two panelists involved to give me quick, short responses from two perspectives. First, starting with Romal, what could South Asia do, or what capability should they build in to attract global investments? And I'd like Romal to talk about from a South Asian perspective. And I'd like Tilan, who's also on the panel, to maybe specifically talk about Sri Lanka. So the same question, but I'm asking Romal to talk about the South Asian because he looks after that region as a whole, and for Tilan to talk to me about the Sri Lankan, what we need to build capabilities in to attract global investments. Romal, you go first.
Thanks, Riaz, and fantastic to be here. I think what was one of the things that as we spoke about the industrial revolution which happened and now the digital revolution that's happening is everything needs to be changed. The nuts and bolts of the world, whether it is in a plane, whether it's in a car, whether it's in a factory, whether it's in any services, including financial services, the nuts and bolts have to be changed. To give you some sense, less than 3% of the nuts and bolts of the world has been changed. 97% remains. And so this is probably one of the biggest revolutions that are happening. And it's a very young revolution because If you look at the Industrial Revolution, maybe over 60 years, the Food and Agri Revolution. So this is only 10 years that has been there in existence. And if you look at some of the trends as well, a very interesting statistic, digital revenue as a percentage of GDP. The general view would have been that probably US is probably going to have the largest digital revenue as percentage of GDP. It's actually not the US, it's actually China. China is 8%, whereas US is 4%. Japan and India are at about 3%. So the emerging markets clearly are the ones where the digital revolution is really focusing. Now, why am I saying this? Because the nuts and bolts have to be changed. So whether it is the cloud itself on top of which applications need to be built, whether it's the hardware infrastructure, whether it is in terms of the analytics that need to be built, whether it's platforms. And one of the interesting things of platforms is also that we've seen small companies, very small companies, making platforms where it's not a one-dimensional, that is the buyer and the seller, but you have multiple companies who can jump onto the platform and provide services. Their investments have grown from, a very small company with, just $5 million revenue being valued at close to $250 million, right? And just in a span of 3 years. So what the really attractive investment would be is to put that intellectual capital to build these kind of assets, these kind of platforms, and be in some sense the service for the whole world. If South Asia can provide it for the global world, I can tell you that our wealth, income increase, and everything else, and the investments into India, and we see constantly companies being picked up, very small companies being picked up by the big folks like Google and Amazon and others at phenomenally high valuations. So if we can build the capability in South Asia around these areas, I think it augurs well for and we have a tendency, if you look at even globally, South Asians are in pretty much really good positions when it comes to most technology companies. So that's a quick.
Thank you. That's very, very interesting. Tilan, you'd like to come up from Sri Lankan. What should we in Sri Lanka do to build in, or what capabilities should we build in to attract global investments? Tilan?
Thank you, Riaz, and good evening to all the panelists. If I were to summarize how Sri Lanka, in the context of its position in South Asia, should orient itself in this new normal, number one, we need to move the policy needle towards greater economic integration with our South Asian neighbors. We must deepen our Indo-Lanka Free Trade Agreement to move into a services agreement. If I may quote some statistics, Riaz, I was part of the negotiating committee as chairman BOI when we negotiated the Indo-Lanka FTA in late 90s. It was signed in 1999. From 2000 to 2005, Sri Lankan exports within the framework of the preferential tariffs under the FTA grew tenfold to India, tenfold. Whereas most of India's export growth to Sri Lanka has been outside the free trade agreement area. So there was, us as a small country, there was greater benefits in Sri Lanka integrating with a larger economy. And we must recommence the stalled negotiations under the Indo-Lanka Free Trade Framework Agreement that will govern services, where there can be greater integration of services, whether it's ports and shipping, ICT, etc. The second most important aspect is sound macroeconomic management does matter, because a point was made about increases in global wealth and the massive injection of liquidity. There is a vast pool of various types of capital available in the world that Sri Lanka can potentially attract. Talking from climate funds, from the Guggenheim Foundation, Melinda and Bill Gates Foundation, the funds that are dedicated for SDG projects. Now, in the process of attracting this money, if sophisticated investors are dwelling on the aspects of exchange risk, Sri Lanka's credit downgrade, that becomes a fundamental problem. So therefore, a sound FDI policy environment must be accompanied by sound fundamental economic management. And that has really been a challenge for Sri Lanka in terms of attracting FDI. The next element is really consistent regulatory environment in order to, in fact, attempt to ring fence some of these investors from the macroeconomic risks such as exchange risks, at least in the short term, till such time Sri Lanka's macroeconomic fundamentals return to a relatively stable position from where it is today, where we are actually, our credit rating is at a historic low. And that was basically the thinking behind the Port City legislation, where a special economic zone, dollarized, was going to be created in order to facilitate ease of doing business within a top 25 type environment from the little under 100 that the whole country is faced with at the moment. So the idea of the Port City legislation is, apart from attracting real estate investments, is to create one of the most livable areas in South Asia for you to do business, for you to have no hassles with exchange control, hiring anywhere from anywhere in the world. So it was fundamentally about the ease of doing business. And the idea of the Port City legislation was also to ensure that it becomes a policy lab. If certain things worked, whether it's digitization, whether it's crypto, whether it's fintech, then it could be gradually rolled out in the rest of the country. And my final comment is that such special economic zones, obviously, apart from focusing on services, should also expand to manufacturing. Now, that is where the southern region comes into play. We have a port in the south. However, we have largely failed to attract our fair share of manufacturing industries that adjusted its supply chain in order to make sure that they had better accessibility to the EU and the EU during the various trade wars that prevailed, particularly under the previous regime of the United States. Now, for that purpose, we now have a port. We need to really improve the industrial and connectivity infrastructure, and the social infrastructure that is required. One final comment I'd like to make in terms of FDI. Yes, I can, the importance of public-private partnerships, importance of understanding in which sectors that Sri Lanka can attract FDI to, apart from tourism. It can be mineral sector, ICT, logistics. But an important aspect to consider at this point is the trickle-down impact of FDI. Now, it was pointed out that the so-called losers in this entire global wealth generation were the SMEs amongst women and minorities. So therefore, governments need to understand and create the required policy environment so that large-scale investments into areas such as agribusiness has a significant trickle-down effect to the individual level of the farmer or the home plot owner. Now, these value chains can be successfully created through micro-level planning. So whether it is tourism, whether it is manufacturing, whether it's agribusiness, whether it's supply chain and logistics, such as creation of cold chains in order to ensure that agribusiness is supported through solid infrastructure. That would be, frankly, my final point in terms of how Sri Lanka can position itself regionally to attract greater investment.
Thank you, Tila. Very useful comments indeed. I'm going to now invite, get Nimal on board. Nimal, you've been very patiently listening. Nimal is a very prominent investor, retail investor. So I'm going to look at some of the retail investment aspects. Given the current situation, Nimal, what in your mind is the future for retail investors in terms of financial instruments in Sri Lanka?
Thank you, Riyaz.
Or in Asia. Yeah. Go ahead.
Thank you, Riyaz.
Yeah.
I would like to more emphasize on Sri Lankan context. Actually, I believe the instruments haven't changed much, but it is the way we approach these same instruments that needs an update. Right. There are the newfound popularity in Bitcoins and NTF like as such, but even these newfound instruments existed before pandemic also. Current low interest environment doesn't give much attractive return on investments like FDs and other fixed income instruments. Therefore, like Sri Lankans, mainly who are living on FDs and other fixed income instruments, to look at different other avenues. So mainly in Sri Lanka don't have much instruments to invest like in developed countries and other Asian regions. So we have to rely on equity market, the stock market. So we must pay serious attention to companies. I mean, when you are investing in these equity markets, radically adapting technology and digitalization in that sense. And this is important because technology and data are overtaking how business operates in this present situation. Although Sri Lankan businesses, like most businesses, complain that our consumers trying to avoid digital presence, like they feel like touch and feel shopping, or with online sales going back after the pandemic to the where it was. So a lot of companies are complaining, but with like time to come, I hope this digital presence will improve. So that most companies should put more efforts to improve their digital presence, especially banking sector, healthcare, even other trading apps in that sense. So this one, what will happen to these companies invest heavily on these digital and technological persons will have proper supply chain and delivery facilities. So therefore, you have to put more efforts for digital aspects. So I am investing in stock market for last 35 years. And I never use technical analysis or any research kind of things, but I always talk to brokers and get information over the counter. But today's trend has totally changed. Today, investors are mainly depending on research, and they do online research, and they have various kind of other avenues like YouTube channels and various groups. They are educating on these online persons. That is how important the digital experience is to the next generation. And companies that get the right will be winners in this race and under new normal. This is the same with banking too. Where people now choose their bank based on how good the apps are. Some people used to change their long time using banks because some apps are not user friendly. So this will be the same with grocery shopping and even food delivery. So also many corporate have taken the new normal seriously, and they have radically adapted to this digitalization effort. So it will be important to pay attention seriously to these corporates. And for some companies, the new business avenues and opportunities have opened up after the pandemic. And this will not go away, and this will remain. For example, like Sri Lankan companies like eProducts and Expo. So they have done pretty well after the pandemic, and we can't expect for them to do bad after the pandemic. So this will remain same. So therefore, we have to stick to that kind of company. Finally, I have to say that environmental and societal impact companies make a huge difference in this sense, and make retail investors go by those points also, because now especially millennial investors, they are very concerned about societal impact and environmental impact. So those companies who are into those aspects also, we have to look into seriously. And now, if I emphasize on this, now Bitcoin, if you take Bitcoin as new instruments, and to mine Bitcoin, you have to put a lot of energy. So that recently came up as an adverse effect on Bitcoin, and people started rejecting Bitcoin kind of instruments, and people started admiring electric vehicles like Tesla and NIO. So people started put more concern and more attention on those kind of eco-friendly, environmental-friendly ventures. So people, when pushing companies to be good corporate citizens with good governance, and that is a good thing for the world also. And also retail investors can put more consent, attention to thematic investments such as wireless economy, like telcos, new interest rate environment can improve constructions and material supply industry. So those ventures also you can put consideration. And when you get vaccinated population, then you can consider leisure and hospitality trade. And those are the ventures we have to consider.
Okay. All right, gentlemen, I have less than 10 minutes left, and I'm going to now take a round of rapid fire questions where I'm going to ask for response of 30 to 45 seconds flat, not more than that. So it's going to be rapid fire questions, and I want very quick 45-second responses. I'm going to start with Indrajit. Indrajit, a lot of people have talked about digital currency, cryptocurrencies, came out in a lot of the discussions. How is the central bank going to regulatory oversight over this? A quick response, please. Indrajit? Have I lost him? Indrajit, are you on mute?
Yeah, I think he's on mute.
Yeah,
he's on mute.
Indrajit, can you hear me?
I was having some difficulty in unmuting. I have unmuted.
No, I'm asking a quick fire 30-second response.
I heard your question. I heard your question.
Great.
So I'll be quick.
Great. Okay.
Yeah, certainly. I think it's going to be very difficult for central banks to regulate digital currencies, which is why I think you're seeing a great deal of wariness about digital currencies around the world amongst the regulators. However, as I think Mr. Bangra said at the beginning, central bank digital currencies, I think it's just a matter of time before they come. So I think the Sri Lankan central bank is also looking at it. And it's just a matter of time before that happens. But beyond that, it will be very tough to regulate.
Okay. So Dumit, I'm going to get you in. How can a retail investor safeguard himself or herself against the volatility of the market?
Yeah, I think this is an issue of two things. One is better knowledge. The other is a matter of understanding what your risk appetite should be. The knowledge factor is really understanding that there is such a thing as asset allocation, right? So I think, if there is volatility in a certain asset class, you don't have to be in that asset class throughout. And sometimes when the volatility comes, you need to take a longer term view, particularly something like equities is not to be, you don't put all your money in speculative short-term stocks. You may have that as part of your strategy, but I think diversification, understanding your own risk appetite, because what you can do as a 25-year-old versus what you can do when you're investing your pension money is very, very different. So I think those two things, knowledge and
Thank you.
Risk appetite.
Thank you, Domit. That was very good. Romal, do banks, financial institutions, do they need to be wary of telcos and digital giants like Google, Facebook, etc., from the perspective of losing customer market share?
Yeah, I think Riaz, clearly telcos or digital companies have a lot of access. They pretty much know when you wake up, when you sleep, where you go. Everything is pretty much known. And now with a lot of the payment patterns also which are happening, they typically know what you're going to spend on. So it doesn't mean that the banks will go away, but banks need to be very careful, because the amount of innovation that is happening with sort of, if you can be an orchestrator of the ecosystem where you can bring in things, then I think you can succeed. You can't win on your own. And I think who does this best will probably win. So, but banks do have to be, of course, wary, because I think there's a lot more competition now.
Thank you. Keith, the next one is for you. We talked about crowdfunding has been talked about. We haven't seen much in Sri Lanka, but I heard of it in other markets. What do you think the future of crowdfunding as an investment vehicle?
I think people have always been concerned when there's an issue that comes up in whether it's someone who dramatically lost their homes or houses to all this new VUCA that's been going on in terms, the earthquakes, etc. So crowdfunding will always be there for that. In terms of ideas like Kickstarter, crowdfunding has been great as a way for the market to see new game-changing ideas without depending on venture capitalists. Crowdfunding is underpinned by the cryptocurrencies, DeFi, NFTs, and more. So great, really, I see crowdfunding now and long into the future, just in different ways and using different methods.
Okay, Tilan, this one for you. We all know there's a lot of money sitting in the Middle East in terms of sovereign funds, who invest in alternate investments or Islamic finance investments, etc. We haven't really attracted much of them. What do you think we should do? A quick solution. Tilan?
Get the country positioning right in terms of where we want to be 5 years down the road. Number two, get the regulatory environment and the ease of doing business improved. For example, Sri Lanka still does not have LLP legislation for us to aggregate capital in a tax efficient manner in a Sri Lankan jurisdiction. Number three, the importance of project structuring. We have to do our own homework. The foreign direct investment institutions such as the BOI, we need to, rather than just going open arms, we need to have specific project structuring experience. And number four, the importance of documentation. Many of the projects that are presented to investors have poor documentation. So if we get these four things right, we can attract a multitude of the new money that's available for FDI, apart from the traditional money we've been attracting in the last 25 years.
Thank you. Eric, this question for you, quick fire one. Sri Lankans typically invest little or nothing in mutual funds with respect to other countries. What some regulatory changes you think are needed to drive this investment in mutual funds?
Okay, actually, I'm not actually a mutual fund person. I've had a very bad experiences, and my family has had bad experiences with mutual funds. So I throw the question back out there. It's like, why should we invest in mutual funds? Is what I would like to hear. Even the UN system, for example, some years back when Kofi Annan was Secretary General, the U.S. company approached and said, "Hey, why don't you put your pension fund into a mutual fund?" And the Kofi Annan said, "No, thank you." Back to you.
Okay, Hervey, can you respond to Eric's concern on why should you invest in mutual funds?
Oh, that's a yeah. Can you hear me? That's a tricky question because nowadays there is this big debate between shall I go into mutual funds with the cost, the fees involved, or shall I go into ETFs and build my own asset allocation and adapt it to my personal need, provided that I make the effort to do that. So I think it's all about the preference of the investor. Are you willing to spend time to understand the market? In which case, you'd better go into ETFs. Whereas if you have no time, no knowledge about that, it's preferable to go into mutual funds and to pay someone to make the allocation for you and not to concentrate your portfolios into specific names. That's extremely important.
Okay. All right, gentlemen, I know I can talk for another half an hour, even 1 hour. We've got an excellent panel here, but time's caught up. I just have to thank all of you. I wish I could have given more time to some of you to express your knowledge and skills and experience, but we need to manage within time scale. So thank you very much for all your contribution, and pass it back to our compere. Arun, over to you.
Thanks.
I'm done.
Thanks very much, Riaz. We deeply appreciate those questions that you fired at all of our participating panelists. Now, the audience that has been listening in on the different platforms have also been very eager to have some questions answered. So we are going to create a few more minutes in our program, and I'm going to be inviting Dinesh, who's been collating those inquiries. And Dinesh, over to you, and you can fire it in turn to those you select in our panel.
Thank you, Arun. Thanks, Riaz. You did a great job. I actually got a whole lot of questions. I picked up 5, and the first question is from a politician. So I thought I'll start with that. This question is: what are the 3 things Sri Lanka needs to do to improve its competitiveness post-COVID? And can I start with Indrajit?
Okay, I think given my background, you won't be surprised to hear that we need to have macroeconomic stability. We need consistency and predictability of policies. We need to make sure that there's continuity. That's one, the macro side. 2 is in terms of the business climate. I think Thilan and others have spoken at some length on what needs to be done. The doing business index is there, the 10 pillars of it. We need to work through that. 3 is, I think, our private sector needs to have a collective voice. They have a heavy weight in the economy. They do a lot of political financing, but as far as I see things, they do not have a collective voice. They try and cut deals for themselves or for their sector. I think we need really, because a stable macro environment, stable political environment, consistency of policies, as I said, legal framework, everything helps every business in the country. So they need to invest in getting the whole business climate better, in getting macro fundamentals better. So, but that's not the impression I have. And there is not enough effort made to do that. Too much of a focus on just particular sectors or particular companies, their own companies. So a collective.
Thank you. Dumit?
Yeah, I mean, I think apart from macroeconomic stability, which I think is very important, I also think our competitiveness going forward will grow not out of low-cost manufacturing, because we know we are not that anymore. It is going to come from the knowledge side. We've talked about this for many years. I would like to see us make a significant investment in the skills sector and education, because I think someone once said recently at a conference that Sri Lankans have education without skills. While I think that broadly that's true, there are some sectors like in our technology sectors and our science sectors where there are incredible talents, that we have great institutions, and we need to broaden that. We need to scale that up to be much more competitive. I think the third aspect of this is actually something that I think even the current government is focused on, which is the ease of doing business. I think at the end of the day, you may have great tax incentives, you may have great inputs for production, but the ability to get in and out and do business, if that's easy, I think we significantly increase the amount of investment that comes in, because I see additional equity investment, I don't mean in capital markets, but additional equity investment as being very much part of increasing our competitiveness as well.
Thank you. And Thilan, you can have the last word.
Yeah, my last word is, let's look at changing the economic narrative, where in fact in 20 years Sri Lanka has gone from privatization and PPPs being a bad word to essentially selling out. Let us really realistically look at the fact that in fact attracting private capital into areas that the government is involved in is the right way to move forward. So even if you look at the situation of the port terminals, the reason that Sri Lanka became a shipping hub was the first ever port privatization that was done in 1999. That was the foundation. So therefore, let's not get caught up on this whole issue of selling assets or what have you, but be in a position to evaluate the merits of attracting private sector investments into areas that the government should not be in business, such as owning hotels, such as owning restaurants, etc. Allow private initiative without the government trying to undermine or compete with private initiative. Just to give you an example, Dumit spoke about education. SLIIT, Sri Lanka Institute of Information Technology, was a private initiative, even though we held public positions at that time, to complement the university education to scale up IT graduates. And today, it gives the largest amount of IT degrees. But there is, again, question marks that are being raised about the fundamentals and the foundation in which these institutions were created. So the voicing, the policy environment must be private sector friendly. And finally, let's be honest about statistics. Sri Lanka has done a lousy job in attracting FDI. If you look at Professor Ricardo Hausman's statistics, in the late 90s, we did 2.6% of GDP in net FDI, and today it's less than 0.5%, post the ending of the war. So we can pad up FDI by putting retained earnings of foreign investment companies and say $1.7 billion came. But in that $1.7 billion, foreign equity is only $100 billion. So let's, be realistic and be honest.
Thank you. Thank you. This second question is to Romal, and maybe Keith also can respond to it. The question is, Mr. Banga said leaders have failed during the pandemic. Has the private sector also failed during the pandemic?
So Dinesh, I think it's a difficult question to say, and it's also situational of whether private sector. But can the private sector do a lot more? And I do sort of agree with Thilan when he talks about this public-private partnership, because nothing today in the world can be done alone. It is a partnership of different ecosystems that can help. So really, whether it's in this pandemic, if we had more things, just to give you an example, in India, for example, we're now looking at health because of the ravage that Corona actually caused us. How can private, public, academia all come together to sort of help in the third wave? So it's really important to bring this ecosystem. So it's not about one failing and the other, but I really do think that people need to work a lot more. And I also agree that there are certain areas that the government should not be in the business of.
Thank you. Keith?
And like Romo said, the combination of public-private partnership is so critical. As director of the National University of Singapore FinTech Lab, we work to help build up the FinTech ecosystem here in Singapore and in Asia. And companies, even banks, can't dive into FinTech alone. I want to contradict what was said, that the public leaders and private companies have failed during the pandemic. Here in Singapore, I would argue that's not true. There's been a very strong point by the government to get us vaccinated, to move things very quickly in terms of efficiency. When I went to go get my vaccine here, I had only a kilometer to go from my house. Most people have a kilometer or two to go. And then afterwards, with clear instructions for rest, and of course, a great work from home policy, which is also keeping everything at bay, we've been able to recover quickly from the vaccine, keep productivity up. And work from home, as the Harvard Business Review had studied back in November, Professor Chowdhury did a review of the US Patent Office and other organizations that had WFA, work from anywhere, and how those organizations like Google and others, but also the Patent Office, government offices, have said, look, work from anywhere. We're going to establish for you a great way to collaborate. So at the FinTech Lab as well, we're at work from home. We're online Zoom every day, all day, from 9 a.m. when the virtual office opens until, well, beyond 5 p.m. when the virtual office closes. And we have guests come into situations like this. And the host just mentioned, Riaz, had said, hey, who expected us to have a conference like this, 2 or 3 years ago? No one did. So the leaders that failed were the ones that said, in spite of COVID-19, I still have to live by, paper and pen signatures, stamping and chopping various things, and they didn't jump on digitalization. And that's what, and you can't jump on digitalization alone. As Ramo mentioned, we all have to work together on that.
Thank you, Keith. I suppose your answer would have been different if you're living in New York.
In New York, yeah. That's true. There was a very different scenario there.
Nimal, can you hear me?
Yeah.
Yeah, there are two questions for you. The first question is, somebody wants to know why you made that controversial statement that we didn't need an investment summit. Any reason for that?
It's controversial, difficult to answer in public. But when a situation like when a country is in a difficult situation where our debt repayment capacity is questionable and vulnerable, and also we don't have proper environment to attract investors, because right now we have only Chinese, how do I say that, attention, like others are not looking at. And when an environment as such, it is very difficult to have this kind of investor forums and get investment. I have my doubt if they can get even $1 within next 1 year from outside China for any development purpose. Because when your rating is down, it is not even investor, it is junk rating. And when you have junk investor rating, which investor will come to invest here? And they spend nearly $10 million, so that's what I heard. But in my personal opinion, it is absurd and not required to do at this time.
Thank you. I'll park that there and then maybe move on to the next question. The next question, I think a lot of people want to know, what are the stocks to look at going forward?
Dinesh, can I just correct one point? We did not spend $10 million because my organization, one co-host, I think we were fully sponsored and funded on this. I'll leave it at that. I just wanted to correct that one fact.
Thank you. Manimal, the other question is, a few people want to know what are the stocks to look at going forward?
SEC will come behind me.
I know you have a big group of followers also.
Yes, definitely. I can recommend like financial sector and COVID-friendly sector, like COVID stocks like deep products, hay cards, and expo. They are going with the trend. And that sector is ideal, and even a financial sector. If you take our three big banks, are trading below 0.05x to market, and very attractive. So even if you buy and keep for 1 or 2 years, you can win on those investments.
Yeah. So your message is the market is very, very attractive.
Yeah, and the market is very attractive. Only problem is no foreign investors. Only 8% participation foreign investments. So without foreign investments, sustainability is the issue.
Okay.
So
thank you, Nimal.
Will look at favorably very soon after this investors forum.
Thank you, Nimal. The last two questions. The fourth question is: equity markets across the region has done well. Many feel this bubble will burst anytime. What approach should retail investors adopt going forward? Can maybe perhaps Duminder, you can start.
Sorry,
you want me to repeat?
Yes,
you want me to repeat?
Yeah.
You want me to repeat the question? Or?
Yes, please. Yeah.
Yeah. The question is: equity markets across the region has done well. Full stop. Many feel this bubble will burst anytime. What approach should retail investors take going forward?
Yeah, I think, look, when markets have come up anywhere from 60 to 80%, that's obviously going to be something that's of concern to people. I would watch two things. A lot of the market drive has been supported by high liquidity and low interest rates, including in Sri Lanka. In Sri Lanka, it's been actually a good thing because we've suffered from very high interest rates, which have really kept the capital markets from developing in all aspects. So this is actually a very welcome change. In markets where rates were low, it went down to zero, like in the US. And that's also grown, 65% plus, I think. So two things I would say. One is, that's why in some of these markets, like in the US, there's a close watch on what inflation and therefore interest rates might do. So again, reallocating assets into other asset classes is important. The second part is, as this post-COVID environment changes, I think you're turning into from growth stocks to maybe some value stocks, because there are actually a lot of good value stocks in all markets. Same thing here. I think in the Sri Lankan environment, Nimal touched on a few companies that did very well because some of the local policy environment around domestic manufacturing. If and when vaccinations come through and the market stabilizes, you will start seeing more cyclical stocks, maybe the financial and banking sector, the consumer sector, and so on, starting to do better, because even though our market's up 60+%, some of those stocks have actually not done very much.
Thank you. Herb, can we have your...
Yeah, well, I would probably have to highlight the elephant in the room, that is the upcoming QE tapering in the US. And, I'm not going to tell you that what we've been through in 2013 is going to happen again. Contrary to that time, everyone knows that tapering is coming, so it's not a surprise. But it changes the big picture. I mean, from a situation where we had this guaranteed $120 billion injected every month by the Fed, we would gradually move towards a zero liquidity injection. So what has been injected is still there, so it's going to support the market. That's definitely the case, but it will be less supportive than before. So my take on that is that we are going to see more volatility going forward, especially when the Fed communicates more clearly about their plan for tapering. But again, as long as the world is still expanding, the world economy is still expanding, we have an environment that is still favorable to equities. So what we can expect going forward is probably less growth in equities, but still positive growth. From time to time, obviously, a drawdown is possible. But as I said before, we are in a context where there is a sort of reassurance among investors that central banks, if there's a need to do that, will come to the rescue.
Okay, Eric, anything from you? You need to unmute yourself.
Yeah, okay, I've unmuted. No, I don't have anything to add in this area, but if you're going back to one of the earlier questions regarding how to accelerate investment in the region, we're all talking about digitalization, but I think for many countries in the SCAP region, we need just to focus on investing in last mile connectivity. And it doesn't have to be a big investment. You can look at Wi-Fi to build redundancy, for example. That's for using lead lighting to in conjunction with Wi-Fi, just so you have a better connection. So while we're all talking about all this digitalization, we still have many countries that still need to do the last mile connectivity. So I just wanted to raise that. Thank you.
Thank you. And to wrap up this session, this final question is for the entire panel. And the question is, what will South Asia look like at the same time next year? Can I start with Romal?
So I wish, Dinesh, I was a soothsayer. But I think the one important thing is really we have to get people vaccinated very fast, because if you don't do that, the variant and the mutation will continue to happen, and everybody will be in danger. So if we can pull that off, I think we are in a very, very good position next year at this time. But vaccination is really key to success, more than all the other things that we spoke about. But that is really the most important thing.
Yeah, Sumit?
Sorry, I was going to say the same. I think that the real question is how vaccinations will evolve. I do believe that Sri Lanka, by the end of the year, early first quarter, we would have got to a level that will provide herd immunity. I think the real question is the size and logistical challenge in India. as well as the, sort of the transportation connections India has with the rest of the region, including us. I think that's of concern. It comes down to the fact that I think you have three really large countries with the populations of 200 million or over, and the challenges that come with that.
Thank you. Tila?
In my view, next year, the country, the global investment community will assign certain KPIs to countries, and there'll be winners and losers. The KPIs will be speed of vaccination, credit rating, economic management, policy consistency, policy reform. Those who achieve these KPIs will do well. Those who don't will be left behind.
Thank you. Herb?
Yeah, I fully agree with the idea that the future of vaccination will determine a lot of things. And the positive element in that is that this global recovery with vaccination making progress will widen geographically speaking. And we would probably be in a very nice environment at the same time of this year, but next year, with major economies around the world fully recovering, and still with positive support coming from fiscal policies and monetary policy, even if there is tapering in certain key central banks.
Thank you. Eric?
Nothing further to add. I mean, here we're still waiting for the vaccines to come. Now it really has to turn to countries' local production. For here in Thailand, we are only 2% of the population has been vaccinated, and we're relying on CIMA vaccine and as well as AstraZeneca. And both are now being produced locally. So I think this is going to be the case, I think for India as well. It's going to have to really ramp up its local production so that we can finally break away from this.
Thank you. Nimal?
My opinion is now India is the key factor in South Asia. So Indian economy revival will depend on all others' fate. And how we maintain the relationship with India will decide other neighbors' fate also, like economically and as well as politically. So India is the key factor. Revival of Indian economy and health is the key factor.
Okay, thank you. And Keith?
We're going to see that the government leaders that really focus on digitalization will bring their countries forward if they have a clear vision for how they can create new jobs. Because we've been talking and dancing around Industry 4.0. Some people, you ask 4 people and you get 10 different answers, but it's really about data, and being able to leverage that to rather roll out vaccines or help people with the economic concerns, etc. We also see greater collaboration across borders, as we've seen challenges from 2016, if you would. Until recently, and still challenges remain in terms of international trade. Countries in Asia, Southeast Asia in particular, need to, they've seen their borders lowered by default by Lazada and Amazon anyway, coming through on both sides. And so they need to continue to do things like have unicorns such as Tokopedia and others really pull together and make a difference throughout all of Southeast Asia through transformation.
Thank you. Thank you. And Indrajit, you can have the last word. You're muted.
I think "you're muted" is the most popular phrase for Zoom.
Yes, yes, I must endorse what everybody else has said about vaccination, and hopefully we can get some degree of normalcy by this time next year. But 2 things, again, what Nimal said just now and what Kiran said earlier about India. Clearly, it has by far the largest weight in the sub-regional economy, and how India recovers is going to be critical. And going into the pandemic, there was a great deal of optimism about the prospects for the Indian economy. And so we need to find ways and means of taking advantage. If the Indian economy rebounds and rebounds strongly, and its growth trajectory fulfills the potential everybody is talking about, we need to work out ways and means of taking advantage of that. And you know, in the past, we had proximity, but very poor connectivity. So the transaction costs of doing business with India are very high. Ports, airports, roads in both countries were very poor. Now all of them are improving. Transaction costs are less. Southern India has been growing very fast. The 5 states of Southern India have been growing very fast. So sitting where we are, and if the Indian economy is able to get back on the trajectory that everybody is expecting of it, then we need to find out ways of taking advantage of that. That's one. 2, if you look at the other countries in the region, Bangladesh is doing very well. Pakistan, on the back of an IMF program, seem to have stabilized their economy. They expect it to grow by 4%. They've, I think, doubled their external reserves. So for us, I think the challenges are, 1, can we get on top of the fiscal challenge, particularly the revenue? How are we going to meet that challenge? Secondly, the external debt sustainability. Those are the 2 things that we need to get on top of.
Thank you. Thank you very much. Over to you, Arun.
Thanks very much. So that concludes it. And overall, I think we've been able to appreciate that there is optimism in the air. But certainly some cautionary notes were also sounded, and those are worthwhile looking into. We've already had the aspect of leadership underscored, and we heard that from Ajay Banga, saying that leaders have not been leading, and they just need to get on with it. But leaving that aside, there were some interesting phrases that we were able to hear, or should I say words that we were able to pick up from different speakers and those that have responded in the panel. Relationship and fairness. So there was that was underscored, that there needs to be fairness, and we also heard that there needs to be reforms at the level of the WTO, for instance, and also that the SMEs need to be looked at in a very positive way to be able to allow them to engage in this whole aspect of the optimistic and the prosperity aspect, that they need to be able to get in because of the fact that they're SMEs, and whereas some of the bigger organizations might be able to do better. Sustainability was touched on, and sustainability with regard to the environment and nature, and that the younger people, those that are in fact in a position to make the decisions with regard to investment, those people are now demanding that sustainability be brought into the scheme of things. And I just thought that something that we did not touch on at all today is what seems to be the increasing prices in oil, in mineral oil, and how that will impact industry and manufacturing and all that sort of thing, and the energy costs. Well, that would be also something that comes up and may need to be thought about. Then also the matter of policy was dealt with, and I think Tilan had quite a lot to say about that. And with regard to Sri Lanka in particular, he said we need to decide what we want to be and then act accordingly. In other words, formulate the policy in accord with those aspirations. And so that's also something that needs to be taken on board. Regulatory aspects were brought in, and also mention was made of the need for proper documentation, that there is a serious lapse there, and those also obviously need to be taken hold of. Well, I think we've spent a lot of time and we've literally shot the mark. We would like to say thank you very much to the sponsors who made this event possible, and thank you also to the partners who have joined with ICC Sri Lanka, Boston Consulting Group, DAILYFT, CIMA, and Port City Colombo. And we have our sponsor video finally concluding this thing. So we would like to have everyone's attention toward that sponsor video also that will be played at the last. And thank you very much also to those that supported the technological aspect of things. Lanka Bell, thank you for that, making it possible for us to use the simultaneous platforms, YouTube and Facebook Live and so on and so forth. So saying, I'd like to say bye for now and do take care. Watch the video.
Thank you.
The International Chamber of Commerce Sri Lanka is the national office of the Paris-based business organization. The ICC comprises of membership of 45 million members in 130 countries. Trade facilitation, export and import and cross-border trade and issues relating to freight forwarding and many other matters of importance are addressed by the ICC. ICC Sri Lanka works through several committees to debate, discuss and suggest solutions on subjects related to the mandate of the Chamber. Each of these commissions are led by professionals in the committee, with many committees functioning. ICC includes a membership committee, International Relations Committee, Policy and Advocacy Committee, Training and Development Committee, Banking Committee. ICC is the sole authorized guaranteeing agency for ATIA Carnets, an internationally accepted customs document which enables duty-free and tax-free temporary importation of items as commercial samples. The ATIA Carnet reduces costs and red tape. The ICC is also known for its popular publications invaluable for bankers, lawyers, arbitrators and anyone involved in cross-border trade. Its members are provided with a member's privilege card which includes discounts with multiple retailers. ICC Sri Lanka's vision is to be the organization of choice to advance international trade and investment for businesses in Sri Lanka. ICC Sri Lanka's mission is to be the change agent in national policy formulation and implementation and facilitator of global businesses with Sri Lanka and disseminator of information on the development of business utilizing the services of ICC Paris while continuing to be a facilitator of dispute resolution. In addition, the ICC Sri Lanka organizes seminars, lectures, meetings with business leaders, and gives recognition to Sri Lankan businesses for outstanding achievements. ICC can play a special role in connecting business to the world and be a driving force for all Sri Lankan businesses.
If you seek for business, look for insightfulness. If you seek for politics, look for anticipation. If you value lifestyle, look for the extraordinary. If you love sports, look for the passion. DAILYFT. Be
Waiting is now a thing of the past with the electrifying speeds of Bell 4G. Bell 4G from Lanka Bell. Why wait?
Strategically located along the 21st century maritime Silk Road. Sri Lanka, the pearl of the Indian Ocean, the key link between the East and the West, offers access to a thriving region poised for accelerated growth. Rising from the seas of Sri Lanka, Port City Colombo is a large-scale reclamation and city development project undertaken jointly by China Communications Construction Company, a Fortune 500 company, and the government of Sri Lanka. Spanning 269 hectares, Port City Colombo, when fully developed, will have a total gross floor area of more than 5.7 million square meters. A modern city where people can work, live, and play. The government of Sri Lanka is actively working on turning this into an international financial city. With new commercial legislation modeled after British laws, coupled with preferential tax, custom, immigration regulations, and other attractive policies, Port City Colombo will attract top multinational corporations and global talent. A state-of-the-art convention and exhibition center capable of hosting large-scale international events will position Port City Colombo as the new hub for business and MICE activities in the region. Port City Colombo will also be the pioneer of the smart city concept in Sri Lanka, where IT expertise using cutting-edge technology creates a seamless living environment, making smart living, smart working, and smart estate management a reality. Port City Colombo has adopted the latest sustainable city concepts, with emphasis on a people-friendly environment using the transit-oriented developments concept to minimize commuting, further enhances the project's sustainability. Port City Colombo will be the most livable city and desired travel destination in the South Asian region, with a 2-kilometer sandy beach, a water channel that flows through the middle of the city, a central park with lush greenery and park connectors traversing across its length and breadth, with the best of healthcare and education. Port City Colombo will be amongst the very best top international cities, world-class hospitality, integrated resort and theme park, a retail destination that is home to the best of international brands and local retailers, a luxury marina will make Port City Colombo a top tourist destination. Building a world-class city for South Asia. Port City Colombo.